Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 295 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. We are doing a additional episode this week given the current market situation, and we hope that everyone finds this helpful during these turbulent times. So a little bit of a different structure. I'll go through the pricing, kind of give the lay of the land of the information that we have right now and kind of what's occurred in the markets over the past few days.
Yep.
And then, I know Matt has some things that he wants to share from his experience and his view on things. But as always, we will start with the performance for the major market indices month to date and year to date. And this data is from YCharts and as of this morning on April 7th. S&P 500 index is down 9.6% for the month and down 13.7% for the year. Dow Jones Industrial Average down 8.8% for the month and down 9.9% for the year. Nasdaq Composite Index down 9.9% for the month and 19.3% for the year. The Russell 2000 Small Cap Index down 9.2% for the month and down 18% for the year. And the Vanguard All World ex-United States ETF down 7.5% for the month and down 2.3% for the year. 3-month Treasury rate at 4.28%, the 2-year Treasury rate at 3.68%, and the 10-year Treasury rate at 4.01%. So moving on to kind of what has been going on over the past couple days, Matt. Obviously, big news in the market last week was the huge sell-off in stocks on Thursday and Friday in particular after President Trump announced his plans for tariffs. And depending on which index you're looking at, stocks were down 10.5% in 2 trading days. And Friday we had another bout of selling and weakness. A lot of that, I think, due to China's announcement of a reciprocal 34% tariff on U.S. goods. Mm-hmm. But I also think it's important to remember that on average, the intra-year drawdown in the S&P 500 is right around 15%. So kind of to simplistically explain that, on average, at some point during the year, stocks usually have a good 15% sell-off, give or take a couple percentage points, right? Mm-hmm. And I think this time it feels worse than that since it's happened so quickly.
Yes.
But it's not abnormal for stocks to sell off approximately 15%, again, give or take a few percentage points each year.
Yes.
Okay? One of the positive news headlines that we received on Friday was the March jobs report. So that
barely got any news on that piece.
Yeah, right. So the March jobs report came out last Friday, and it was strong. Non-farm payrolls pretty much smashed analyst estimates, coming in at adding 228,000 jobs versus analyst estimates of 113,000.
That's a blowout.
It's a blowout, and it's good news that at least for right now, the labor market remains strong. So obviously that was overshadowed by the tariff news on Friday, but again, at least for the time being, the labor market isn't seeming to crack, so to speak.
Well said.
So again, in my opinion, Matt, the Trump administration wants to accomplish a handful of things with this new trade policy, right? So number one, he wants to structure more fair trade deals. Number two, increase manufacturing in the U.S. And number three, increasing revenue to the federal government without raising income taxes on Americans, right? Mm-hmm. But to me, if companies move their manufacturing back from overseas, they're no longer going to be importing as many goods as they were in the past, which would decrease the expected tariff revenue the administration hoped to receive to pay down the federal debt, essentially, right? So as we've been saying, we don't think that the current policy is economically viable and sustainable. Therefore, again, we are still in the camp that this is a starting point to further negotiate current trade deals, because if companies do move their manufacturing back overseas, then tariff revenue is going to decrease, right? So again, we do think this was structured in a way so that it's a negotiating starter for the new administration.
That's important to digest, I think, for our listeners and viewers, is that the way it's being proposed now as a negotiation tactic, if this were just set in stone as it is today, on a more shorter term basis, the next, say, 2-3 quarters, that would not be an optimal situation for the stock market.
Correct.
Just to be very direct about that.
Yeah,
okay.
Absolutely. So just a few thoughts before I turn it over to you, Matt. And for our clients, some of this stuff was in my note sent out last week, just giving an update on the current situation and what our thoughts and outlook is. But again, these types of events can be unsettling in the short term, to say the least. But it's important to remember that trying to time the market around geopolitical or policy developments is extremely difficult.
Very difficult.
And often counterproductive. And history shows that making short-term trading decisions based on headlines often does more harm than good for long-term investors. And markets often adjust quickly, and policy developments can be complex and fast moving. And, in moments like these, staying disciplined is key. And a good example is what we experienced back in March of 2020. I know that was, a little over 5 years ago now, but the market was extremely volatile over several weeks, and there was no shortage of uncertainty. But by staying the course, investors were able to participate in the strong recovery that followed, and 2020 ended up being an exceptional year for investment performance. And we view the current situation kind of in a similar light, challenging in the moment, but not a reason to deviate from a well thought out long-term strategy. And we will continue to look at times of uncertainty like right now and market weakness through the lens of opportunity. And even though it is extremely difficult in times like this, patience is key. And eventually this is going to pass, and eventually it's going to provide, in my opinion, some massive opportunities in the market if we just remain patient. And obviously we don't know the exact date that that's going to happen. We are continuing to believe that it's going to be sooner rather than later. But a lot of the times when we go through situations like this, the best thing to do is to sit on your hands, even though that can be frustrating, right?
Yep.
But again, this isn't the first time this has happened. It's not going to be the last time that this has happened. So with that being said, before we get into some more research on what's going on, Matt, I'll toss it over to you for your thoughts, comments on the current situation.
Yeah, I think there's two overwhelming topics I want to start with, some words of wisdom and then just a reminder about how the market works. Let's start with some words of wisdom. I want to start with a Wall Street quote that I've only used in 2001, 2008, and 2020. So this will mark the fourth time that this quote is applicable. There are decades where nothing happens, and there are weeks where decades happen. This is one of those times. Another important reminder is stocks don't crash to oversold levels. They crash from oversold levels. That is what you are seeing now. You are seeing the capitulation effect between last Thursday through this morning around, let's say 9:45 a.m. when the market was open for the first 15 minutes. The capitulation effect is after you've kind of saw a little bit of a bleed in February and March, then you kind of have the capitulation happen, and that's what you saw. I'm going to talk about how the markets work, and I'm going to come back to the Treasury Secretary, my comment there in a second. I think it's important, Mark, for our listeners and viewers in times like this, I think it's important for us to discuss how these markets work. Because I don't think investors, they don't fully appreciate the luxuries of modern day markets. And when times like this occur, especially over the last 3 trading days, it's a very feral, raw environment. And it just brings you back to kind of how the market was a long time ago. So let's take a second. Everything in the publicly traded markets are something called mark to market. It is priced literally by the second, okay? There's advantages of that because you know exactly what your investment is worth at any given second. But in times of uncertainty, you have price discovery, okay? So again, in mark to market, you know exactly what that stock or what that bond or what that investment is worth. The market is quick to price in uncertainty and automatically begins to assume a worst case scenario. In order to find a buyer, if you want to sell, the buyer will demand a discount to account for that uncertainty. The degree of the discount will be commensurate with the degree and speed at which the uncertainty is growing. This is all my own words that I wrote this morning. In times of great volatility, it is human nature to have our investment time horizons come in fast. It's challenging for investors to see their portfolio balances drop double digits in a week. Friday was unique. Friday officially set a new record for the highest number of shares ever traded in a single day in the U.S. stock market history. This is according to Goldman Sachs. Over 26 billion shares changed hands across all the exchanges. It beat the previous record of 23.67 billion traded on January 27th of 2021. Guess what? There were buyers for every single share of stock sold on Friday. There were buyers for all of them, okay? Price discovery is the face of the uncertainty is not fun. We have to realize price discovery in these extreme environments, that buyer on the other end, they're going to ask for a discount. We got to understand that. So I think we need to be careful in making any panic-related decisions for 2 reasons. 1, the market is deeply oversold. 2, this is an event-driven sell-off. Any change to policy will immediately lead to a sharp rally. I have a case in point just a couple hours ago. From 9:45 a.m. to 10:15 a.m. this morning, 30 minutes, the S&P 500 index rallied 8% in 30 minutes. I've only witnessed a handful of times during when the market is open to see such a move, let alone in modern day times, compared to when I was writing paper trade tickets and put them in a bank vacuum to get sent to the person who enters it. This is a market that cannot be timed. And I would just be very careful. We are in one of these very rare moments where I think things will come to fruition sooner rather than later. But could we have another 5 to 10% more pain before the bottom is in? Anybody's guess. But I will just throw it out there. In these event-driven sell-offs, all it takes is the Fed to come out, do an emergency rate cut. I lived through those environments multiple times, and I have seen rip-roaring short-term rallies. Are they sustained? Anyone's guess. But I just want to throw it out there. This is not a market I would try to time. I would feel very strongly about that statement.
Yeah, I don't disagree with anything that you said, and I think your comment about publicly traded securities being marked to market is very important. And I think an example of Something that's not marked to market is like a private investment, right?
Keep going, because I think the delineation is important.
That only gets updated once a quarter or semi-annually, whatever that is. So you don't see the fluctuation or the volatility of that, right? Because that specific investment or asset class could have, a month or two of severe underperformance, but then it could rally back up and, let's say, just for example's sake, that it was only down 3% at the end of the quarter. Well, in the middle of that quarter, it could have been down 15 or 20%, but you don't see that because it's not marked to market, right?
Correct.
So, I think we've made this comment a couple of times that it's awesome that people have, instant access to view their investments and their account balances whenever they want. But the negative side of that is I think it forces people to make rash decisions during times of panic or times of market stress that we're going through right now.
Yeah, I think I had this idea in my mind about a white paper that I want to draft over the next couple of years. And I want to back it up with some research. And it's along this main narrative. The more modern times that we're in today with the information flow, I could make a valid argument that corrections are going to be quicker and deeper than they have relational to the situation in the past, and the recoveries are going to be quicker. And I think a very case in point is what you're seeing now. All these sentiment surveys are telling you it's just as bad as the fall of '08. And I want to control my emotions. There is no way you can relate that. There's no way you can relate that. But everyone would tell you it's that case because how quick the market's moving on news that is not relatable, but they're trusting the price movement. And I think just a lot of it has to do with the modern age compared to how easy it was to see those values, to trade. I mean, grab your smartphone or your tablet. People weren't trading off of their phones and smart tablets in '07 and '08.
No.
No.
Why
don't you go over some of the tweets, articles, and research, Mark, that caught your eye over the weekend, and then I'll reciprocate.
Yeah, for sure. And we'll have a couple more pieces than we do on average, just because I think it's important to kind of share everything that we're looking at right now. But the first thing that I wanted to talk about today in terms of research was the volatility index. So as a reminder, the VIX, or the volatility index, essentially measures the fear in the markets.
Yes.
Okay?
Yes.
So when the VIX is rising, it usually coincides with a falling stock market. And on Friday, the VIX spiked to 45, and I wanted to just see all of the other times that this has happened and what the forward performance has been for stocks after the VIX crosses above 45.
This is important in my opinion. Keep going.
And as of this morning, it got to over 50, actually. So this data is from Sentiment Trader, and Jenna will throw this chart up for our YouTube viewers. It'll also be in our show notes, but I'll walk through this. So it's a chart of the VIX going back to January of 1986. Mm-hmm. And all of the red dots show each time the VIX spiked to a level of 45 or higher, okay? The forward returns are really interesting, Matt. So if you look 1 month later, the S&P 500 is higher 74% of the time for an average return of just under 4%. Mm-hmm. 3 months later, S&P 500 on average is up just over 11% and higher 87% of the time. You go to 6 months out, average return for the S&P 500, 16.5% with a win rate of 90%. And then 1 year later, average returns a little over 27% and a win rate of 90% of the time. Does this mean the market bottom is in? No. The VIX could definitely go a lot higher, but history shows if we keep the long-term mindset, things tend to work out pretty well.
Yeah, I think you said it very well there, Mark. To add to that, the reason I like watching this indicator is it's not going to necessarily time the ultimate bottom on this day at that time. you know you're in the vicinity, looking at the lens of history, of good buying opportunities. And I think most of our clients, I feel very strongly, I'm saying that conservatively, are very long-term minded. And again, I know it's jarring to see this in the short term, but when I see stats like this is something you want to see if you're wanting to know you're in the vicinity of a bottom. This is what you want to see.
Right. And this stuff doesn't happen very often.
It is a non-common occurrence.
A handful of times. And again, looking back at history and the data that we have, these tend to be really good long-term buying opportunities. Okay. So, me and you were talking on the phone last Friday, and I wasn't sitting in front of my computer at the time of this conversation. And I asked you where the VIX was. And I think my response was, it's not high enough yet, right? So
I could have just said that perfectly for Jenna. He's not
so
high. I can tell you exactly what he said. It's not high enough without hesitation.
Right, because we know, based at looking at history, spikes into the 50s or higher, and even into the 70s.
That's what you want to see. Then.
You start to see capitulation in the market as we get closer and closer to a market bottom.
The data I know is a little skewed because it's coming very quick today. One of my data sources was quoting a high for the VIX this morning of a 60 handle.
Yeah, it was.
Okay, making sure I'm seeing that correct.
It was at 60.
Pre-market. Okay, making sure I was seeing that correct because it showed like 60 point. Don't quote me on this exactly, listeners and viewers. 60.34 was like what I saw, but I did see a 60 handle.
Which might sound crazy, but at this point and where we are, I think that's a good thing.
Given where we're at right now, yes, I would agree.
I would be more concerned if the VIX was continued to be more subdued, because at that point
it's not showing panic.
I would think that there's a long way to go, right?
Yep.
The second thing that I have is a chart from TCW with data from Clearnomics and Standard & Poor's that shows the impact of missing the best market days over the past 25 years. So all of this data is going to be based on an initial $1,000 investment in the S&P 500 without transaction costs. So again, this chart will be up on the YouTube video right now. But ultimately what it shows is that if you miss the best days of the year for the market, your return drops substantially. Okay?
Yep.
So if you remain fully invested and you don't miss any of the best days in the market, that $1,000 over 25 years turned into a little more than $3,800. If you missed the 5 best days of the year, that $1,000 turns into a little more than $2,400. Dramatic, over $1,000 less. Just by missing the best 5 days.
Okay.
If you miss the 10 best days, $1,000 turns into $1,770. And if you miss the best 30 days, that $1,000 drops to $674 over 25 years.
I mean, that's a great stat to bring back into vogue. And again, I want to say it again. I will very rarely, maybe a dozen times in my lifetime, will I see the S&P move 8% in 30 minutes. It is such a rarity.
And the reason why I bring this up is that the best days in the market for the year and the worst days for the market during the year usually cluster together.
They do.
Meaning, if you have the worst days in the year in the beginning of the year, it's very rare to have the best days be at the end of the year. Because volatility is so high, volatility can work in both directions, up and down. So this is what you typically see when the market is trying to figure out this price discovery and put in a bottom, is you're going to see the best days and the worst days be very close together, which again, just goes back to our recommendation of not panic selling right now, because like you said earlier, we could have a day, 2 days, 4 days, 5 days of extreme upside volatility very quickly.
I have a piece that will complement this great. I have a chart I'll share in a little bit that shows the best and worst days, and it shows them in green dots and red dots. It's 4 standard deviation moves up or down, and it shows them all clustered. So you will see exactly what you just said. I have it visualized in a minute.
Perfect.
Okay.
Third thing that I had was another chart from TCW, again with data from Clearnomics and Standard & Poor's, showing yearly returns for the S&P 500 with the maximum pullback or drawdown during the year. So this chart should be very familiar to our regular listeners. Essentially what it does, it has pretty much 2 data points for each year. The blue bars are the S&P 500 index total return for the year.
Yeah.
And then the red dots on the lower part of this chart represent the biggest intra-year decline.
The drawdown.
And this goes back all the way to the 1980s through year-to-date 2025 as of April 4th. And the thing that I want to point out here, Matt, like we've talked about before, and it wasn't that long ago, but I think now that we're in the thick of it, it's important to bring this back up. Some of the best years in the market had some of the largest intra-year drawdowns that we have seen.
Yeah, I know where you're going with this. I don't want to steal your thunder because I think you're going to talk about.
And like I said earlier, the most recent example of this was COVID. In March of 2020.
Keep going. I was hoping you'd say that.
At the worst point during 2020, the S&P 500 index was 34% off of its high.
Off of its high.
Off of its high.
Yes.
And the S&P 500 finished the year up 18%.
Up 18%.
So that is just one example of this. Another example of this, back in the early 2000s, the largest intra-year pullback was negative 14%. That year finished up 29% for the year. Back in, it looks like 2009, largest intra-year pullback, down 27%, finishes the year positive 26%. So my point here, Matt, is that just because that in this graphic, it shows S&P 500 is down 17% from its high, that doesn't mean we're going to finish the year there.
Yes.
And more likely than not, it will finish higher. Will it finish in the negative still? Maybe. Will it get into positive territory? Maybe. But it's pretty clear from this chart that you usually don't finish at the lows for the year.
I mean, I got a kind of a bold statement I'll follow it up with. So you're telling me that all this money that's come out of the market since February, you're telling me it's going to find its way to the bond market and not come back to stocks?
Right. So I think that this is a really, really good chart to remind ourselves during periods like this, because volatility is something that should be expected year in and year out, not obviously to this extreme or to this magnitude, but more often than not, we do not finish the year at the lows, which is, again, another reason why it goes back to our recommendation of not panic selling. You see a constant theme here. It's all tied back to what are the detriments of selling and getting more conservative right now. Yes. And I think all of this data that we're presenting right now shows that if you were to do that, it usually does more harm than good, and it's counterproductive.
Well put.
Next thing I had was a post on X from our friend Ryan Dietrich on April 6th, showing forward stock market performance after the S&P 500 drops at least 10% in 2 days. So
I bet that's a big data set.
Doesn't happen very often,
it's
right?
Very rare.
So last Thursday and Friday, believe it was April 3rd and 4th, the 2-day return for the S&P 500 was a negative 10.5%.
It made the clip.
Okay. Mm-hmm. So this chart that Jenna has on the YouTube video right now, it shows all other instances where this has happened. Okay. And then it shows the 1, 3, 6, and 12-month forward performance for the S&P 500. And this is going back to 1950. So since 1950, this has only occurred 6 times. So very rare.
Just take that in for a second again.
Right.
I mean, I think people need to hear that again. This
Yeah,
has
it's
only happened
six
times since 1950.
Yeah, it's crazy.
Okay.
What is that? If my math's right, 75 years.
That's
6 times in 75
6 times.
years.
Keep going.
So again, small sample size, but if you look at the forward performance for the S&P 500, it tends to be very strong. So in months after the S&P 500 drops 10% in 2 days, 1 month later, S&P 500 is higher 100% of the time for an average return of 7.9%. 3 months later, S&P 500 higher 80% of the time for an average return of 6.6%.
And the only time it was down in that instance was 08, complete structural issues with the financial system, not comparable. Keep
Right.
going.
Next, 6 months later, S&P 500 was higher 100% of the time for an average return of 15.8%. And last but not least, 12 months later from the S&P dropping 10% in 2 days, S&P 500 higher 100% of the time for an average return of 32.6%.
Numbers, I know it's a small data set. It's a rarity that this type of stuff happens, but the data speaks for itself that patient investors who don't overtrade tend to be rewarded. Is that guaranteed? No.
Not at all. Could be different this time, but those are, as we've talked about, some of the most dangerous words that you can use in our industry.
Very dangerous.
Lastly, before turning it over to you, Matt, last thing I had was a chart from Renaissance Macro Research showing the S&P 500 index and past tariff spats going all the way back to the early 1900s. So I've seen a lot of media headlines saying, well, this time's different because we've never had a tariff situation like this.
Ooh.
And I'm not saying all tariff spats or tariff events are the same, but this is not the first time there have been an issue with tariffs, okay?
Yep.
So it shows chart of the S&P 500, and then it has little green arrows below the S&P 500 that shows all of the different tariff-related situations
Accompanying the event.
going back to the early 1900s.
Got it.
And then they also list the forward performance for the S&P 500 after these events, and the numbers, in my opinion, are quite strong. And I just want to run through those.
Please.
So the forward returns for the S&P 500 after major tariff events are as follows, according to, again, Renaissance Macro Research. 1 month forward returns average 4.6% with a win rate of 56%. 3 month forward returns average of 7.4% with a win rate of 67%. And then 12-month forward returns average 14% to the upside with a win rate of 78%. So again, thought it was just important to point out that this is not the first time we have had a situation like this. And again, if you are of that long-term mindset, tends to work out pretty well in the long run.
Love that you highlighted that. So my first piece is going to be about the credit markets. I've talked about it in the podcast a lot over the last couple of months. Credit spreads. You would want to see these credit spreads kind of move higher to the upside. So for our regular listeners, they're going to understand what that means. For newer listeners, credit spreads, the ones that I reference, is the difference from the risk-free rate, let's say a 10-year Treasury bond, versus what a subprime company, non-investment grade company has to pay an additional interest in order to entice investors. And to entice them during times of uncertainty, what do you think investors are going to want, Mark?
A higher rate.
More interest. You got to compensate me for that risk. Well, you're seeing that as of Friday. It went to, before these issues over the past week, it was, say, around the 3 to 3.5% level. We're now around the 4.5% level. And still in regards, if you go back to March and April of 2020, that spread was over 10%.
Right.
Still not crazy. So the bond market I think is telling me, hey, we think this is going to be more short term. We don't think this is going to actually do anything yet. That could change. So that is my first point I want to throw out there. Second, expect volatility to be elevated for some time. My first chart I want to show is the chart I referenced to you earlier. It's the S&P 500's best and worst days tend to be clustered in times of stress. Source here is Tier 1 Alpha on April 5th. Jenna will put up this chart for our YouTube viewers. This will be in our show notes. It's a friendly reminder that volatility works both ways, which is why it's reasonable to expect a sharp upside move at some point this week, even if nothing materially changes. My biggest surprise of the day, my bingo card, I had everything blank. I didn't have any expectations for today because anything can happen. On my bingo card, I had one I marked in, which was at 11:15 or around that point this morning, the administration comes out and escalated the tariff rhetoric with China, who I think is the number one issue in the administration right now with these tariff talks, and the market didn't sell off anymore. That was very telling to me. That's a very good sign. But again, these best and worst days, look at this chart, Mark. You were spot on. They tend to be clustered. Be careful.
Yeah, when you're looking at this chart and you're looking, it's quoting the data based on standard deviations, and just a simplistic way to understand that is, when you're 4 standard deviations above or below the average or the mean, it's just very abnormal for that to happen, and it usually
Good way of saying it.
Tends to happen in extreme markets.
Extreme. You go 3 standard deviations that quick, you're like, okay, something really bad's going on.
Right. And then, what you have following, again, no timetable on that, is some sort of a reversion to the mean, right?
Yes. Okay. A couple more things, and then we'll let our listeners go. I know we have to get back to our terminals. On April 5th, Bespoke had a piece showing the 2-day rate of change, and any time it got below that 10% that you highlighted. This is just showing the chart a different way that you verbalized. Extremely rare going back to the 50s. So 2 last things, sentiment, and then what I would be looking for next. Sentiment is as poor as it gets. I can sit here, listeners and viewers, I can reference multiple sources, but understand what you're seeing in sentiment data is September of 2008. It is March of 2020. Nothing else in modern times. Very uncommon, and I feel not fully relatable, in my professional opinion. Last but not least, what I would be looking for next. This is my personal opinion. Time is not on the side of the administration on how they're handling the situation. If enough time passes, permanent damage will be caused, which will lead to a recession. A recession is not good for anyone. It's not good for the administration. It's not good for the American economy. It's not good for the global economy. This is what could happen in the near future. Companies will start to take firm actions to deal with the impacts of tariffs. A lot of companies are forward-looking, planning for 2026 already. This could lead to a pause in hiring, cutting of earnings projections. Layoffs could be drawn up at some point to preserve at least some better net profits. What I would be looking for in the markets is, especially over the next week with some of these deadlines on Wednesday and Thursday, is to see some cooler heads prevail, the Fed possibly stepping in, pausing of tariffs, negotiations being announced. The next week is very important, in my opinion, to the trajectory of the market over the next year.
Yeah, and when you talk about, Wednesday and Thursday with, another April 9th, deadline per se with the tariffs, can you just explain that a little bit? Because I think most people are under the understanding that every single one of these tariffs are currently in place right now.
Yep.
And when you're reading just short media headlines
Yes.
or notifications on your phone, it could be a little misleading.
Well said. So to say it very direct, when the announcement was made last week, it was an instantaneous 10% with the additional tariff that was mentioned. So let's talk about China as an example of 34%. That 34% full tariff doesn't go into effect until Thursday. So what the market was hoping or anticipating is that leading up to Wednesday night or this Thursday morning, you have a list of, okay, we're going to pause these full tariffs on these nations because they want to talk. We got the list. And on these that didn't, that's going to go into effect on Thursday.
Yeah.
So this plays into the usual playbook of the current administration, for better or for worse, which is they are telling you what they're going to do. And in some cases, they already put the 10% on, but that goes into effect later this week. And so I think you're going to see a lot of corporations who are going to wait, just like a lot of investors are, to see what actually happens later this week before taking any sort of concrete steps. And that's why I feel the next week is going to be very important.
Right. And I think it's important to understand that, because all of this market action that you've seen over the past, let's call it a week, is going based on information that is not fact yet or not implemented yet.
Correct.
So it's not like all of these tariffs, have been in place, right? And that's part of the market, right? It's forward looking. It's trying to figure out what the next 6, 12, 18, 24 months are going to look like.
Yes.
But it is important to know that, it is not going based off of concrete fact that this is happening.
Yes. I mean, this is why the market is quote unquote mark to market. One final thought that I think is important. Be careful in watching what the market is doing when the market is closed. I'm going to give you an example of this. The futures market opens up at 6 p.m. Eastern Standard Time on a Sunday night, okay? At one point during the night, the market, depending upon the American indice you looked at, was down between 4 to 6%, right? And when the market's not open, the volume can be thin, very thinly traded. Price discovery is a lot harder when you have low volume of trading. And then the market opened up today, and it's slightly down compared to what it was overnight. So I also want to throw some words of wisdom out there. Be careful trying to judge where the market's at when it's closed, because those volumes are very thin.
Yeah, and a lot of times by the time the market opens up, it's kind of nowhere near those prices that it was trading in the,
up or
the
down.
futures market. Correct.
Well, I think we're going to come back later this week on Friday. We have a special guest on the podcast, unbeknownst when this was scheduled, with the crazy market volatility that Mark and I just discussed. That's going to be this upcoming Friday. We're going to have JC Peretz on the podcast. We're going to record that early afternoon, and I know Jenna will do her best to get that out either Friday or Monday as quick as she's able to do.
Yeah, I'm excited to listen to that one. I won't be a part of that one, so it'll just be you and JC, but I think it'll be a very insightful, interesting conversation, especially given what we're going through right now.
Yeah, and I'll just say, if you are an existing client of Jessup Wealth Management and you have anything you would like to talk to us about, pick up that phone, give us a call. I can just say up until when we started recording this at noon on April 7th, we received 2 calls of our 430 households. So not a lot of concern per se, but I don't want to take that for granted. And if you don't currently utilize our services and you'd like to run your situation past us, given the extraordinary moves in the market, we're open. Give us a call.
Yeah, well said. Well, thanks everyone for tuning in to episode 295. Matt and JC will see you all later this week.
Take care, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.